Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about a very big firm, a large cap firm which has become a mid cap company, BHEL or Bharat Heavy Electricals Limited. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Now about BHEL, most of you would be knowing as to what the company does and what businesses they are into. But just to give you a snapshot, they provide capital goods and electric equipment services, heavy equipment services to clients. Plus, they are into electric supply, and so they provide electrical ancillary products. It's a large cap PSU company which has turned into a small cap one. Uh, the economic slowdown has hurt the industry a lot, the whole industry, and BHEL is not just an outlier, and it has suffered a lot over the past probably a decade or more than that. The stock has performed exceptionally during the 2003 and 7 bull run. It was a bull run that was dominated by companies who had taken a lot of leverage, and it was based on high interest growth. So the interest rates were low, and it was appreciable growth in the field of infrastructure, capital goods, etc. And that's where BHEL really benefited. It has a very good dividend history and has kept on paying dividend over the past 15-20 years as a PSU stock. For people who want safety in terms of dividends, it's pretty good, but not in terms of safety with respect to the stock price. As we talk about the numbers, this is numbers which are compared year on year on the June quarter, June 19. So the sales were down 20%, and this time around they had a loss of 221 crores versus a profit of 130 crores. So the company has turned around on the negative side with respect to their performance on the bottom line. The only positive is the high dividend yield currently at a price of 46-47 rupees. The dividend yield is 4.7%, which is quite appreciable compared to top-notch companies who are right now faring at a half times percentage or 0.5% dividend yields. The numbers are deteriorating because of the economic slowdown, and you would understand that obviously they make business when the economy grows fast, and right now we have seen how the economy has slumped into 5% or slumped to 5% when everybody thought that by 2020 or 21 India would be growing at 7.5-8%. They need huge orders to move the needle, so it's not like they are like Sadbhav Engineering, just quoting an example, or some other company, Kredhan Infra, or some other infrastructure or capital goods company which is small, where even 100 crore or 500 crore or 1,000 crore order will move the needle. They need orders worth 7,000, 8,000 crores to really move the needle, or at least in excess of 2-3,000 crores, which looks difficult in this phase that these kind of orders would come into BHEL. So the reasons for stock fall has been heavy industry, like the heavy industry business have been under pressure. So all the capital goods or high intensive industries have been under pressure for the last 10-15 years. It's not that they're under pressure under the Modi government or during the Congress government. It has been under pressure since 2010, and over the last 9-10 years we have seen only capital erosion in this sector in all the companies, including Larsen and Toubro, which has performed much better than BHEL, but still not made as much money as it would have been or other companies as they have done. Continuous lower profits and slow growth has meant that the stock has continuously fallen. So now, as we have seen that the company has gone into losses, so we can understand that that when the company goes from high profit growth to losses, the stock price will fall, and it has fallen more than 90% from its peak of 2007-8. It has never attained the glory of the early 2000s. As I mentioned again, during that period, it was the bull run which was aided by capital goods industry. It was aided by high growth in infrastructure. And since then, we have not seen a similar level of growth in India as it was during 2003 to 7. And when you look at 2 3 years hence, the future doesn't look very bright. So it doesn't seem like that the industry is going to turn around in a jiffy. You can invest now. We could see bounces. We could see some news that that the government is going to pinch in with 10,000 crore, 20,000 crore into infrastructure. But the ground reality is nothing has moved on the ground, that the business has not picked up on the ground in terms of this industry. So that's why people, because stock market is always about investing in the future, so people or investors are looking at what the future earnings would be. And when you see some any company who would not do well in the next couple of years, they would not touch that company. So there are better options available in other industries, say for example information technology or pharmaceutical. Just quoting an example, with 72 rupees to a dollar, it would definitely give you 8 10% at least appreciation in terms of dollar rate, etc., plus the growth of the company, organic growth of the company itself. So you can get 16 18% in that stock, rather than diluting your money or reducing your capital by investing in capital goods company. You reduce it by 20%, you can gain around 15 20% in IT and pharma. And there are many mid and small cap companies in other sectors as well, which are consumer sector, in which you can gain even more. So, what are the reasons to avoid? Overall, till now in the presentation, you would have understood that I am not in favor of buying this company even now, even at 46 48 rupees. Who knows that later on they would perform even worse and not get into profitability. The stock may fall even to 20 25 rupees. The capital goods is a high investment sector, so where the investment has to come in not from the private sector but from the government, and it has to come in big time, something like 20 lakh crore, 10 lakh crore amount of money going into infrastructure. And that's where these kind of products of capital goods, heavy machinery, would be used. It is heavily dependent on high rate of GDP growth. So it's not that a GDP growth of 5 or 4 5 6% would help. When you have a GDP growth of 8%, that would really help the company grow fast. At 5%, it would not help BHEL make any big profits. It is not a market leader. So even if you invest in capital goods, I think L&T is a much better option, Larsen& Toubro, rather than BHEL. It is a private company and it is run well. The efficiency level is much better than what BHEL is, although there is differences in terms of the products that they make, but still investing in Larsen& Toubro would be better. It is a PSU company, and PSU has never made money over a longer period of time, over 2 3 years. Yes, you can say when the tide is turned and tide is moving towards you, it can make money. Otherwise, PSU companies will never make money. I'm not in favor of buying such public sector units. And there's a high gestation period and project completion, so it's not cash and carry business. There's no money that is coming in and pumping and you can make money straight away, that you sell biscuits and get the money out, or sell detergent and sell washing machines and get it. It takes around 6 months to 1 year to get the money into your profit and loss account. So this was a video on BHEL. Please like and subscribe my channel, hit the bell icon so that you can get my video straight away when I post it. Thanks a lot for watching.